Well, the Bank of Canada just did something that they haven't done since May 17th, 2000, almost 22 years ago. It raised the overnight rate by 50 basis points, or said differently, half of a percent. And it's also going to start the process of quantitative tightening later this month, signaling that more rate hikes are in the cards. This rate increase isn't unexpected, and it isn't cause to panic. Yes, it could be said that the bank has doubled their rate, but really an increase from 0.5 to 1% is still only just a half of a percent. So to say it's doubling, really, that's like clickbait, and it's disingenuous. Retail bank prime, the rate that we actually pay attention to as consumers and as Canadians, it will be increasing from 2.7% now to 3.2%, or said differently, it's about an 18.5% interest rate increase. Now, this rate increase today now reverses half. That's half of the interest rate decreases that we experienced in May of 2020, right as the COVID-19 pandemic was sweeping across the world initially. So we have room to go still before rates get back up to where they were right before the pandemic. And you know what? We'll likely see a little bit of increase beyond what that rate was as well, which would see actually the prime rate being a little bit higher than it was since 2009. So it's been a long time since we've seen the rates this high, and we'll likely see it there at least for a period of time. Now, in rationalizing the move, or this recent rate increase, the bank singled out the invasion of Ukraine by Russia as the new economic uncertainty that is causing supply disruptions, exacerbating ongoing supply constraints, and of course, weighing on economic activity. So there's clearly uncertainty there. We know that it's having an impact on bond rates, which is a big part of the reason why we've seen fixed rates increasing recently as well. But that's a whole nother topic that I'll address here soon on another video. Now, it's no surprise that we're experiencing very high levels of inflation. Everybody's talking about it. It's no secret, right? And you know what? This inflation isn't just energy costs. It's kind of everything. Much of it is still a result of supply struggles, but the war in Ukraine is, of course, adding to that, especially in the energy cost sector. And the bank is suggesting that we're going to see GDP growth. That's the most commonly used measure of economic growth. It's not perfect, but it's the best we've got. We're expecting about 4.2% this year and another 3.2% in 2023. Now, currently, CPI inflation, that's the most commonly used inflation index, it's expected to average about 6% for the first half of this year. They measure it after the fact, which is why we're saying it that way. And they're expecting it to ease toward about 2.5% toward the last half of 2023, and all the way down to the 2% target in 2024. So it's going to take a little while, but we will get there. And of course, once we're there, the need for higher interest rates starts to subside and go away. So the bank tells us that with the economy moving into excess demand and inflation persisting above the target, that interest rates are going to need to rise more in the future. So we've seen 0.75% of increase so far this year, 0.25% in March, and now 0.5% here in April. But we're likely going to see at least another 1.5%, possibly as high as 2% more increase between now and probably the early part of 2023. The exact pace of these increases does remain unknown, but the bank will do it as they see fit. And really, don't be surprised if we see probably 0.25% increase again on their next announcement date, which is June 1st, 2022. So currently, I'm telling clients to expect about a 1.5% increase above the increase that happened today. So that would actually get us, like I said, above the highest rate that prime has been since 2009. But even with that much increase, we're still going to see interest rates lower than what taking a brand new 5-year fixed would be today. So if you're taking a variable based on the rates today after this increase, you're looking at a rate just above 2%, increasing by 1.5%. Still leaves us well under 4%, and new 5-year fixed rates are hovering both sides of 4%, depending on the lender and, of course, some of the specifics on what you're borrowing for. So as always, everything is individual, right? Advice needs to be personalized and tailored to each person. So, as always, my team and I are here to help you. We're here to advise you, and we want to help you find the answers that you need. So, whether you're looking to refinance your mortgage, or maybe a mortgage you already have is coming up for renewal and there's a conversation to be had there, or if you're looking to purchase a home here in the next little while, please reach out to us. We're definitely here to help you. We've got lots of information and we can help you plan for this uncertain future.